In this week's video, we'll review the latest charts to help us answer these two questions. Stocks, how bad was it? And how bad could it get? We'll start with the more concerning and ugly charts. We started nailing down some profits over 2 weeks ago, primarily in our growth and tech-related positions. When we got to this peak here at the close on Wednesday, that was the 5th trading session where we nailed down some profits. Even with the proactive approach, still difficult here. Here's the peak on Wednesday, the drop on Thursday, the magnitude of the drop, extremely rare. Only 2 other times have we seen something similar the day after making a new all-time high. We know failed breakouts are concerning. So this is a failed breakout look now. Here, not good. Here in a similar area, not good. All 3 cases we were overbought. We'll cover these conditions later in the video. But this is unquestionably concerning. The longer we have a failed breakout look, the more concerning it becomes. In terms of conceptually, how bad could it get? This is a similar look here. This is pretty bad. This is a similar look here, and this was pretty bad. This case, to be determined. A little bit of a mixed bag on this chart. The bad news is yields today are still lower than they were on March 23rd. This is the date of the major low. A little bit of a silver lining here. On Friday, this is 10:39 a.m., it wasn't a mad dash into bonds. Yields were rising. It's a daily chart of the VIX. Let's focus in on 2009 after the low. See how the VIX is falling here? In 2009, we never get up in this area here. That's where we are today. When did we get back to this area? Right before and during the flash crash, and this was a tough period to be in the stock market. Prefer not to have a look like this. Credit markets, JNK relative to IEF. The S&P 500 has exceeded this high. This chart, this ratio, having trouble clearing the 61.8% retracement, somewhat of a failed breakout look or failed breakout attempt to clear the June high at this point, or at least a stall. And a fan principle, 3 trend lines broken speaks to a higher probability of a reversal. Could this get back on track? Absolutely, positively, yes, but we need to see it get back on track. BKLN, huge spike in volume during Thursday's session. Triple Qs, NASDAQ 100, huge spike in volume during Thursday's massive sell-off. The concern is, look how much volume there is in here. This is not what we want to see. This right here is bird strike 101, and this right here, until proven otherwise, until we see this corrected in some way, is bird strike 101. Not all bad news here, but it's not encouraging that the Dow was unable to close this gap here. This is something that we've been keeping an eye on for several weeks. I'm wondering how the Dow would act in this area. This is still a hesitant look. We haven't given up this trend line, but right now this looks like a failed breakout attempt look. More defensive-oriented gold relative to stocks, trying to rally here from a logical level. RSP, equal weight S&P 500 index, we're looking at it in isolation. This is a failed breakout look that we have right now relative to the June high. And we're still quite a bit lower than the February high. Equal weight tech relative to bonds also has a failed breakout look intraday on Friday, September 4th. This is a weekly chart. Triple Qs relative to gold also has a failed breakout look intraday. We'll see how this chart looks at 4 p.m. Is there any good news? Yes, the S&P 500 intraday on Friday was still trying to make a stand at this level here, and this trend line here is still intact. From a trend perspective here, a longer-term trend perspective, nothing particularly alarming, except we have to keep in mind, this really didn't look too bad here either, and this is what happened. If we look at the fibs relative to this A to B move from the low to the high, It's good news. We're well above the 38.2% retracement, which is approximately in this area here. If you look at JNK relative to TLT, if we look at this rally and the retracement, still above the 38.2%. In fact, it looks like we tried to make a stand there. And on Friday, intraday anyway, JNK was beating TLT by 0.5%. Some good on this chart. This lower high at this point would be concerning. Equal weight S&P 500 relative to the standard weight S&P 500. Still trying to make a stand, and we don't have a breakdown look on this chart yet. We'll learn something either way. If it moves in this direction here, we could redeploy some of our capital into other areas in the market. If it moves in this direction here, probably we'll still maintain a defensive bias. That is to be determined. There is some good news on this chart. SCHG relative to TLT still have some hope of making a stand in this area here. There's several areas of possible support. The bad news is this breakout to a new all-time high now looks like a failed breakout look intraday on Friday, September 4th. There's a lot of information typically in failed breakouts. The longer the failed breakout holds, the more relevant it becomes. That's our way of acknowledging there's no market law that says this is a failed breakout yet. Price could go in this direction. But we need to see that. We need to see these things that we're concerned about improve. The market needs to prove it to us before we stop locking down profits and or taking on a more defensive posture. This is basically SPY divided by IEF stocks versus bonds. Here we're still well above this June high here if we drew a line this way, and we're still above this trend line. The last thing SP low volatility relative to SPY did was make a new lower low. Really hasn't done anything yet to correct this downtrend. Intraday on September 4th, high beta relative to the S&P 500, trying to make a stand here at a logical level. If you're a stock market bull or an economic bull, you'd prefer to see this move in this direction. That's the potentially good news. It hasn't fully broken down yet. The bad news is this is an extremely lower high relative to the June high. We'll talk about this chart later in the video in detail. Intraday on September 4th, it'll be helpful to know that this breakout right now on the weekly chart at 11:17 a.m. Eastern Time is still holding. Now let's shift gears to an opportunity cost analysis relative to stocks and bonds and our allocations. Got a lot of information to cover, so we will be moving quickly. Feel free to use the pause button on your video player. Tweet from Monday's session basically said, wouldn't be shocking if the S&P 500 dropped 3.5% to 6.5% from current levels. The data presented in the remainder of the video will help us with the following. Navigating markets is similar to playing chess. We must always be thinking several moves ahead and in the context of possible moves from our opponent, in this case, the market. All of it needs to be considered in terms of the impact on our mindset and subsequent ability to deal with a wide range of outcomes, including those that may be highly stressful and widely unanticipated. All of the charts and all of the research that we conduct each week helps us with these concepts. When we were performing studies earlier in the week and creating some of these slides on Wednesday, it really might not have made a lot of sense relative to the market making a new all-time high. The information that follows will probably make a lot more sense after Thursday's brutal sell-off. We're going to be talking about getting tactically, strategically, and mentally prepared for the next 6 to 36 months. Back in early April, when the market told us to keep an open mind about a bottom being in place and to keep an open mind about much better than expected outcomes walking forward, there was a very, very high demand for bonds at that time and little to no interest in stocks. We're basically covering general concepts using general terms here. Near the low, everybody loves bonds and everybody hates stocks. The further you move away from the low, the more stocks are loved and the more bonds are either hated or ignored. One of the keys to managing risk and reward is to be an early adopter in terms of shifting gears down here, and to be an early adopter in terms of shifting gears up here or somewhere in the future during a rally. So earlier this week, we wondered, how attractive are bonds after a move like this? Of course, to answer that question, we want to use facts. This is the 114-day trading session rate of change for the S&P 500. It has been 114 days since the March 23rd low. The 114 count is as of September 2nd. And in this case, we'll be looking at the apex of the rate of change. The apex in this case, August 19th of 2009. The only other time, with the exception of what's occurred recently, that we've touched this green dotted line, January 18th, 1983. So what we're trying to understand here is when we reach the apex in the present day and this line starts to come down, what does history tell us from an opportunity cost perspective about the relative attractiveness of stocks versus bonds? In all three of these cases, the present day, 2009, and 1983, stocks have come a long, long way at this point here, and at this point here. If you know your market history, the good news is this comes after a major stock market low in 1982, and after that, really good things happen. And this comes after a major stock market low that occurred in March of 2009, and after that, from a longer-term perspective, really good things happened. But conceptually, you would think at this point here and at this point here, many market participants love stocks and they're basically ignoring bonds. Therefore, it might be helpful to ask and answer, how did stocks and bonds perform walking forward from August 19, 2009 and January 18, 1983? To answer that question, we'll be looking at returns for the S&P 500 in this area here. We'll be using a mutual fund VUSTX. Doesn't go all the way back to 1983, so we'll look at the 2009 case to see what we can learn. After an extremely rare run in 1983 and in 2009, similar to the run that we've had in the rearview mirror in 2020, it's not shocking that the stock market had to digest some of the gains looking out 1 to 3 weeks. And anecdotally, if we look out 2 months, the average gain in these two cases here for the stock market was 5.77%. The return for the mutual fund, bond mutual funds, which is similar to TLT in the ETF world, 1.17%. And in these anecdotal cases, the outperformance from the stock market continued into the third month, 9% relative to 2%. But something happens between 3 months and 1 year out. 1 year later, bonds beat stocks in both cases. And on a relative basis, bonds are attractive 1 year out, 2 years out, and 3 years out. Given the big drawdown that we experienced on Thursday, it might also be helpful to ask and answer, what type of drawdowns did investors have to experience in this case and in this case to get to the right side of the table? We looked at the maximum drawdown looking out 1 month to 1 year. The reason why these numbers are always the same is the maximum drawdown occurred in the first month in both cases. We never look back from there. In 1983, we gave back 4.39% in the S&P 500. In the 2009 case, we really never looked back. From the recent high of 4.39% give back would take us to 34.28 on the S&P 500. From an odds perspective, if we hold above this, we learn something. If we drop significantly below it and remain below it, we learn something from an odds perspective. If you pause your video player here, you can see that between 1 year out and 5 years out, in these two historical cases, both stocks and bonds performed well. Walking forward from August 19, 2009, which is similar to early September of 2020, bonds gained 40%, somewhere in the neighborhood of 40% over the next 3 years, which is very, very similar to the stock market in the 1983 and 2009 case. January 18, 1983 is also similar to September of 2020. So we get a massive move off the low from March to August of 2009, which is similar to the move that we've seen in 2020. Walking forward from that point, this shows the performance of SPY and TLT. You can see we typically oscillate between stock outperformance and then bond outperformance. Stock outperformance, then bond outperformance. But this gives us some idea what the next 3 years looked like from an opportunity cost and risk-adjusted perspective. Why risk-adjusted? Because if we can produce similar returns by adding bonds to the portfolio, that helps from a volatility perspective and a drawdown perspective. Just to reset, in the present day, the move in the stock market, extremely rare. Only seen something similar 2 previous times in the last 40 years. August of 2009, similar to the present day, and January of 1983. In the 2009 case, and we know from previous videos, there are a lot of similarities between 2020 and 2009. In that case, the stock market continued to outperform for roughly an additional 8 months. This is QQQ in green, SPY. In red, this is IEF, intermediate term treasuries, longer term treasuries, TLT here. Walking forward from August 18th, 2009, volatility increased, but stocks continued to outperform. And then, as you might have guessed, when stocks outperform bonds for a long period of time, this is August 18th to April 23rd. If we walked forward from April 23rd, really just the opposite happens. Bonds significantly outperformed SPY and QQQ for roughly 4 months in 2010. Thus, this slide and these bullet points tell us to keep an open mind about stocks continuing to outperform, and maybe for as long as 8 months. At some point in the future, whether it's now or 8 months down the road, as it was in the 2009 case, at some point we have to be open to bonds significantly outperforming stocks again, and thus it's prudent for us to consider increasing our bond exposure. How might we do that? If we're fortunate enough for the market to continue to rally for a few more weeks or a few more months, typically selling into strength and adding some bonds along the way. Why are we doing this? Because we know in most cases, at the end of an extended rally, the stock outperformance is eventually given back. So if we walk forward here from August 18th, 2009, which is similar to September of 2020, yes, stocks killed bonds for another 8 months, but that outperformance was basically given back looking out roughly 1 year from August of 2009. This looks out 12 to 13 months. If we walk forward from August of 2009, looking 3 years out from the date of the signal, stock and bond performance was basically even. Common sense tells us when stocks significantly outperform, at some point the market's going to correct that and close that gap. Here's an example here. Here's an example up here, and here's an example here. The same thing can be said when bonds significantly outperform. Typically, at some point in the future, they come back together again. From an evidence perspective, we would like to see a little bit more deterioration on this chart before making significant moves over to the bond side of the portfolio. This was the look of the chart on Wednesday. We were up here. It looks like a bullish breakout. Now we're coming back, testing the June high and testing this upward sloping trend line. Not making any assumptions here as to whether or not any of this will hold. We'll simply trade the chart in front of us. A chart like this and numerous others will help us decide what a prudent allocation is between bonds and stocks walking forward. Similar concepts here, a study we performed earlier this week, chart dated September 1st. This is bonds, the Vanguard Long-Term Treasury Fund, think TLT, relative to an S&P 500 index mutual fund. Why mutual funds? We have data that goes back further. This is very, very similar to TLT versus SPY. This is, again, the 114-day rate of change, bonds versus stocks. This tells us that bonds have significantly underperformed stocks over the last 114 trading days. It's extremely rare to see a period of underperformance for bonds similar to what we experienced in the rearview mirror. You can see by looking at the chart, it's rare to get down near the green and the blue lines. We've exceeded the green line in the present day. And looking back to 1986, there are 6 cases where you came down and hit the green line or exceeded the green line. How did stocks and bonds perform walking forward after an extreme period of bond underperformance similar to what we've seen in the rearview mirror in 2020? This is noisy. This is all of the cases here. These are the green line cases. There's 6 of them. This shows you the performance of bonds walking forward using this mutual fund. This shows you the performance walking forward for the S&P 500 index. The bottom portion of the screen shows you the average, median, and percent positive cases for this data source at the top. Matches this. This table here is summarized here. Looking out 3 weeks historically, the median case, a little bit of outperformance for the stock market, but then when we get into this box here, 1 month to 5 years, it starts to get a little bit dicey just to hold stocks. Somewhat of a mixed bag from week 1 out to 3 months. And once again, between 3 months and the end of 1 year, there's some type of transition that takes place. And at the end of a year, the average outcome, bonds were up 10%, stocks 5.5%. 2 years out, basically a wash. 3 years out, very, very even. 4 years out, slight advantage down here for stocks. And 5 years out, very, very similar. Basically telling us if the evidence continues to deteriorate as it did on Thursday and as it has in some ways over the past several weeks, charts we've covered in these videos, if you're a client, it wouldn't be shocking to see us bump up this side at a faster rate. One of the rules we have here at Shavako Capital, we never want to take more risk than we need to take. If you can produce similar returns from a probability perspective using bonds in the portfolio, we'd prefer to do that to complement stocks to tone down volatility and risk. None of this predicts the future, nor does it tell us what's going to happen 1 week from today or 5 years from today. It simply gives us some historical precedent and a reference point for these rare cases here where something happened very, very similar to what's happened in the rearview mirror in 2020. The psychology of investors is similar here, 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 and here. The same can be said for the cases, the more extreme cases, where you come down and hit the blue line. The present day case is one of the extreme cases. It's only happened 2 previous times. Thus, you can make an argument that psychology in the present day is most like this case here and this case here. Basically the same analysis we just went through with the green cases, but now we're looking at the more extreme blue line cases. The average return for bonds, average return for stocks. This summarizes this table. This summarizes this table. Let's take a closer look at the August 12th, 2009 case. Very, very similar concepts. 3 months out, stocks outperformed bonds, but somewhere between 3 months and 1 year out, we get a transition. And stocks don't pull away from bonds again really till year 4 and year 5. Simply telling us to keep an open mind about a more mixed allocation if the evidence supports that walking forward. The chart in front of us and or the charts in front of us and the data in front of us will guide those decisions. All of this simply helps with context. We never trade or allocate based solely on a historical study. So we just looked at the 2009 case a little bit more closely or graphically. Let's do the same with the 2011 case. We'll look at bond performance and stock performance. Walking forward from February 8th, 2011, things flipped rapidly. TLT significantly outperformed SPY between 2/8/2011 and 10/3/2011. In fact, in the 2011 case, for the most part, across the board here, walking forward, bonds outperformed stocks. There's another way of looking at the same opportunity cost type question. This is TLT bonds divided by QQQ, or the NASDAQ 100 ETF. It's a daily chart. This is RSI here. This is an extremely quote-unquote oversold reading. How rare is this type of underperformance for TLT relative to QQQ? If we walked forward from 2004, how many times have we seen something like this? The only time we've come down that far is September of 2020. None of these cases touch the blue line here. Therefore, it might be helpful to know, how do the NASDAQ 100 and bonds perform walking forward? Between December 2nd, 2004 and April 28th, 2005, bonds significantly outperformed the triple Qs, telling us to keep an open mind about a wide range of outcomes, telling us to keep an open mind about a wide range of allocations walking forward. In this case, when the deterioration started here and the separation started, was there evidence in hand to help us with that? Yes, this is SPY-TLT here, so we're looking at stocks versus bonds. You can see the breakdown here in early 2005. It's right in this area here after we could see this, measure it, and put it in a model. Bad things continued to happen for several months in the triple Qs, and over that period, bonds continued to outperform on a relative basis. This is simply an illustrative example of the weight of the evidence. So let's go back to the original chart, TLT divided by QQQ, going back to 2004, daily chart. If we arbitrarily draw a trend line, you can make an argument we're near potential support for TLT relative to QQQ. Also noteworthy, here, TLT is quote-unquote way overbought relative to QQQ. And you can see here, an overbought market or ratio can keep rising for some time. This is several months in here. And conversely, it's also possible for a rare and deeply oversold market. The ratio is oversold here, and after that, bad things continued to happen in the ratio for more than a year. Overbought can keep rising, oversold can keep falling. This simply tells us to pay attention. There's a higher probability of a reversal. Doesn't predict a reversal. You easily could have said, we're way overbought here, time to get out. We're way oversold here, time to get out. And in each case, the market continued to move in the same direction for quite some time. Is there anything we can do from a probability perspective to try to discern between an overbought market that may be ready to reverse and an overbought market that has higher odds of continuing to move in the same direction? Here, we've been looking at TLT divided by QQQ. Let's flip that because it makes a little bit more sense intuitively here to look at QQQ, risk on divided by risk off, or TLT. Here's the ratio here. This is a moving average cluster. This is the 200-day in red. RSI in an overbought state here, but you can see it's relatively early in a new trend. Relatively early in a new trend, this can be positive. The trend continues. Trend's been going for a while now. We get overbought. It tells you there's a higher probability of this overbought leading to changing conditions. And that's exactly what happened in this case. Really, the main gist here is you get trends, consolidation, typically some type of breakout. Once again, we have somewhat of an overbought condition here, but it looks like it's at the early stages of a trend after a period of consolidation. Better odds here for the trend to continue, lower odds here. We're way up here, overbought now, and the market's moved a long way. Once again, none of this predicts anything. It just helps us assess odds. Regardless, we always trade the chart in front of us and make decisions based on what happens, not what we think is going to happen. When you get up here, the market needs to consolidate its gains. When you get up here, the market needs to consolidate its gains. Sideways movement, trend. Sideways movement, trying to break out here. So anecdotally, this is a successful case here. This is a successful case. Is there anything that's discernibly different between the successful overbought cases and the unsuccessful overbought cases? You can make an argument the answer is yes. Number one, bullish moving average crossover with the cluster in the 200-day. Number two, our overbought relatively rare condition. When we look backwards, this is different from this. And number three, bullish moving average crossover, overbought condition occurs near a breakout to a new high. We don't have all three here, and we don't have all three here. We do here. Overbought condition occurs near a bullish moving average crossover and near a breakout to a new high. We can make an argument in the present day we have all three today. Bullish moving average crossover. This is rare relative to what we've seen in the rear view mirror. This is rare relative to what we've seen in the rear view mirror. This is rare. So this looks pretty good on September 2nd. The question is, will the breakout hold? Here you have a retest. Here, down here, there's a retest of this. And up here you get some consolidation in that general area, a little bit of a pullback. But ultimately, this is going to be governed by price. But this tells us here it is possible that the 1, 2, third time will be a charm here, but that's to be determined. Notice what the moving averages are doing in here. It's a mess. Notice what they're doing in here. It's a mess. It's quite a bit different from this trend here and overbought consolidation. Quite a bit different from a market that's been trending for a long time and gets overbought. And in both cases, that's followed by sideways consolidation. The sideways consolidation is followed by a breakout, followed by a breakout, followed by a breakout. Notice during the consolidation, we really don't get overbought in that manner in here at all. Same thing here. We don't have anything like this in the rearview mirror until we get back here. Thus, you can make an argument this looks more like this than it does this or this. And in this case, good things happened. This breakout here, to be determined. You would think at some point your harder market's going to be followed by an easier market. This has been an extremely hard market. It's got to prove it before we can say we're into an easier market. Won't spend a lot of time on this, but you can make an argument we have a similar but not as good setup with the S&P 500. Have our overbought condition occurs near what is a bullish moving average crossover. This and this are occurring as we break out to a new high. This is during Thursday's ugly session with the S&P down 116 points. We'll learn something in here. A failed breakout and a move in this direction would not be good from a probability perspective. The longer a breakout holds, the longer we're above the green line, the more relevant it becomes. Same thing with a failed breakout. The longer you stay below and the more forceful the move below, the more concerning it becomes. Right now, we're still above this level here as of Thursday's close. Some of these looks here tell us to keep an open mind about a move in this direction and a successful breakout. This is the S&P 500 in isolation. We were just looking at QQQ relative to TLT. Both of those are somewhat constructive and lean bullish. We've shown this chart before. This one does not lean bullish. This is SPY divided by TLT. And this chart tells us to keep an open mind about much worse than expected outcomes. No bullish breakout here. We have a downward sloping trend line. You really want to see this look here morph into something like this eventually. Hasn't happened yet. See how it plays out. This is more on the pessimistic side of the ledger. This is evidence. This is 2:06 p.m. on Thursday, September 3rd. This is the optimistic side of the ledger. This is hard evidence. QQQ relative to TLT still holding the breakout. Notice how much different this setup looks here relative to this one here. This is still the end of 2018 here. end of 2018 here. Which one will win out? To be determined. But if this breakout fails and really fails miserably, we will respect that. You can pause your video player here. Better yet, Google this title. You can find this article on CNBC. Obviously, there's a lot of legitimate concern relative to the election and the possibility of problems with the mail and ballots. History tells us typically volatility drops in the 3 months prior to an election. How do we handle the election? Trade the chart in front of you. If the election's a problem, this breakout's probably not going to hold. We've covered a lot of information from this point down here to this point here that tells us to keep an open mind about better than expected outcomes. This analysis from LPL Research also tells us to keep an open mind about better than expected outcomes. Pretty rare for the S&P 500 to have a consecutive 5-month win streak. What happened walking forward? 3 months later, 65% of the cases were higher, average gain 3%. But look, a lot of red in there, so you have to keep an open mind looking out 90 days. 6 months later, got even better. 81% of the cases higher, average gain roughly 6%. 12 months later, 96% of the cases higher, average gain 12%. Worst outcome, basically flat. None of this predicts anything. It simply helps us keep an open mind about this breakout holding or having a successful retest or a scare that's followed by higher highs. Clients that pay close attention know we've been making some adjustments to the portfolio, trying to nail down some profits along the way. It's a tweet from David Cox in the middle of the day on September 2nd, so this is Wednesday when the stock market's doing extremely well. Asked him if we could use this in the video because we were talking about this concept, Kathy and I, the night before. When you get to the point where the last ones standing are your strongest trends, in this case for the most part, tech and growth, eventually, if it's going to fail, they come get everybody. This set of facts here on Wednesday at 1:12 p.m. told us to keep an open mind about worse than expected outcomes, and thus Thursday's session not particularly shocking. How it plays out, to be determined. We'll learn a lot Friday's session and Tuesday through Friday of next week. I think it's pretty easy to keep an open mind about a wide range of outcomes when on September 3rd we have a chart that looks like this, and on September 3rd we have a chart that looks like this. And the best way that we can accomplish all of this is to simply trade the chart in front of us, which means the charts in front of us. Multiple charts, multiple ratios, multiple time frames, and it also means to trade the data sets in front of us. And we know the only way that we can do that successfully is to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.